Hello, everyone. Welcome to another live trading session. Today is Friday, October the 20th, and we have an interesting day, so I hope you're going to like it. We have a few things to go through, and I'm going to talk about some recent changes that I implemented, and we're going to take a look if we can close some trades or maybe potentially open some new trades. And to do that, let's first just take a quick look at the market and see where we're at for the week. So as you can see here, the market has been going straight down for the last 3 days. We're approaching the same point we had a couple of weeks ago, low point of around 2200, right around 4200. And that obviously means that the volatility has gone up a little bit, and some of our positive delta trades are, showing negative P&L at the moment, but as you know, that's at the moment that's all just paper losses, and we are in good shape overall. So we'll go over that in a second, and we'll open the account and take a look. We're a little bit down on the day, and we've been down for the last couple of days, but this is something that's normal. And I don't know if you trade options, you assume that you'll have some losses. Most of them are paper losses for a while, and then some of them turn into real losses. So those are the ones that we want to avoid, and we're going to go over our account and see if there are any trades that are showing a potential real loss, but potential need to close the trade with a loss. And just a quick reminder, we don't really want to lose any more than 200% of the premium we collected on the naked puts on any given trade, and that allows us then to multiply that with the number of trades that we have, and that would show us some type of a maximum drawdown in a normal market environment without any black swan events. So that's something that I want to talk a little bit more about, and I'll make a video, maybe even over the weekend, a video about determining your potential losses and how you're going to then size from that point on. Before we go there, let's take a look at some of the trades that we might want to close on the SPY. We have a few put debit spreads here that some of them are actually showing profit, and one of them is expiring today, and it's slightly in the money, and that's the one right here that you can see. It's 424, 417. The market, the SPY is at 422, which means we're a couple dollars in the money, and we only have until the end of the day to cash in. So as usual, you don't know what's gonna happen over the next few hours. So let's just take a look. Let's assume we're gonna close this position just so we can open it here, and let's clear it. So this is the position right here, and as you can see, we're in the money right here. So we could close now and get a little bit of profit, or we can let it go until the end of the day and see where we're at. So now this is a decision. There is no right or wrong answer, it can go either way. So in this particular case, I think that we are overall in a good position with all of our other trades. And let's take a look at the actual one-to-ones across the account. I opened a couple of new trades last few days this week. So this is the one right here, trade number 20. And then number 19 was opened here, naked puts, and then the put debit spread is right down here. And these are obviously all in one expiration. That's why it's showing as a group here. And if you take a quick look here at the naked puts and the deltas, everything is basically under 15 delta, so nothing is getting challenged here. So we are fine. We don't worry about that one. Here on the older trades, we have few that are that have their put debit spreads expiring today. Those are right here where it says 0, 0, 0. Those are the put debit spreads expiring. And my trading plan calls for a stop loss of an overall stop loss of 200% on the naked puts, but that's broken down into two stages. The first stage is when we have the put debit spread open, we can allow the naked puts to go up to 400% loss, counting on half of that being made up by put debit spread, which would at that point show profit. And I'll show you that later. That's kind of what's happening down on some newer trades. And then once the put debit spread is closed, then the stop loss is moved from 400 to 200. So for example, let's take one of these trades that is expiring here. So on this 3800 put, it still has 28 days to go. It shows 53% profit, and the put debit spreads are expiring here. So this is not the best example because it's positive, but let's go something that shows negative. Let's go here, this one. Okay, put debit spread expiring today, 28 days to go, showing 45% loss on the put on the naked puts. That gives us $90 of minus of negative profit P&L. So as you can see here, we're as of tomorrow, we're not going to be getting any more protection from the put debit spread. We don't probably get any more protection today either, or last couple of days, because they only had a day or two to go. And but that's beside the point. We're not getting any more protection. So we need to now think about the stop loss moving from 400 down to 200, but that's again nowhere near 44%. So we will still have another 150% to go before this trade is stopped with a loss. So we're not going to do anything here. We're just going to let it ride. And we set our expectations at the beginning of the trade, and we count on the possibility that any given trade will lose 200%. That's our risk tolerance. That's what we take on before we put a trade. Before we put a trade on, we know that we are taking that risk. And again, I'm going to make a separate video just to go and break down how that works with the whole account versus single trade. Everything about that. But just so you know, here we're not surprised, or we're not afraid with this. If this goes to 200%, we're going to close it with a loss. We're going to move on, and that's it. But for right now, that's not in the cards. We're still fine. We have to allow the probabilities to work out, because if this trade had roughly 90% chance to be successful at expiration, we have to allow that. If we start closing these trades once they show 50% loss or 100% loss, then that probability of winning will go dramatically down. Even 200% will lessen it. It will bring it down from 90 to maybe 85 or something. But given our put debit spread that's active for the more than half of the life of the trade, allows us for that first half of the life of the trade to increase that stop loss to 400, thereby giving these trades a real chance to have their probabilities work out. So that's it on that. So let's move on, and let's go back to the trading question, the one right here, because I was thinking on this SPY trade. Just too many things open. Let me just close this down. So I'm thinking what I'm going to do here. I'm going to just close this trade. It's showing, let me see, this trade is showing $100 profit. And it may show another 100 by the end of the day, or it may show 0. So instead of guessing, and since we don't desperately need that additional profit, we're just going to go ahead and close this. And let's just close it and move. All right. That's done. So now we booked that little bit of a profit. We still have a couple of other trades to go. This one goes for 7 days. This one goes for 21 days. And they're both showing a little bit of profit because of the market move down. Now let's take a look at some other trades in the account. All of these put debit spreads, and this is now interesting to see, because we don't often have an opportunity to show how these one-to-ones work, because for the most part, market is not dropping down, 3, 4, 5% in a short period of time. And given that this trade is designed to withstand that kind of a pullback, we don't often get to showcase that. So today might be a good point to see the difference between the 1-to-1 and your classic 1-1-2. 1-1-2 will be showing profit on the put debit spread as well, but that's maxed usually at around $200 or so. And here we have this put debit spread has been open for 4 days. 9 days, 10 days, as you can see here. And this one is showing $45 profit. This one is showing 60, 58, and 18. So this is just the beginning of their profit, because they have another $1,000 to go, or 1,500 at the max, because most of them are 300 wide. So we have plenty of room for the market to pull back further and for this profit to increase. Right now, for example, this trade number 19 is bringing in $43, and the put that naked put that's associated with that is losing $160. So this one is bringing it down. How much more says? Let me see, 40. So this one is bringing it down of around 20-30%. But that's probably not the best example, because this trade is very new. On some of the more matured ones, it will show even better ratio. So let me see. Let's just take a couple of them. This one is showing $120 loss, 103 overall. Let me just see this one. This one here is, for example, this one is 240 down to 170, still not too strong. Let's see this one. This one is not showing too much loss, $60, so not a great example. Let me see, we'll find something. All right, this one here is a little bit better. You see, this one is bringing from $256 loss on the naked puts, bringing it down to 157. So taking basically $100 off of that loss at the moment. But if it continues to go down, we still have plenty of room in the put debit spread to kick in and help. But you can see how this is amortizing the losses, allowing us to keep the trade open for longer than we would be able otherwise. We would kick into stop loss sooner. So let's take the numbers. Let's take the numbers into our sheet and see where we stand with everything. So the VIX is 2155. 2155. Delta 186 and 87. 186 and 87. And this is actually, let me just do the buying power so we see where we stand. Fresh it. MES 36.4. 36.4. Okay. So it's flashing here red on Delta, but one of the adjustments that I'm doing is I already a while ago I stopped really doing theta. Actually, I monitor theta, but I don't really actively manage it anymore, because I don't think it's needed for the type of trading I do. It might be needed for somebody who is doing different type of trades where the theta is important to stay in certain range, because, for example, if you have a bunch of strangles and things like that, it's usually theta that will trigger the that will show you where you stand and maybe cause you to either add on trades or take off. For the type of trading I do, I figured that theta is what it is, and I monitor it. But obviously, if it gets completely out of line, I would consider it. But before that happens, my delta and my buying power would probably be out of line. And pretty much, not the same, but pretty much similar thing is with delta. All of these are positive delta trades, and I accept the risk of each trade when I put it on. So I don't want to stop myself from putting trades when I have enough buying power, when my premium sold is within acceptable range, and premium sold is directly related to my maximum drawdown under normal circumstances. And I'll talk about it just briefly after this. But I don't want delta to influence that too much, and I'm going to allow delta going forward to increase a little bit more and not stop me from putting the putting the trades on when I feel that it's needed. Because if I don't do that, what ends up happening is that I'm putting more trades on when the VIX is low, when my deltas are low, and then I put less trades on when the VIX is high and when it's actually more advantageous for me to put a trade on. And that really, it's not the way I want to have my portfolio structured. And I want to make sure that my trades are scattered over different expirations and not all around certain periods of time when my delta was in line, right? So the bottom line is, I'm going to put much less emphasis on delta, and I know it's going to be high, but it's only high according to certain rules that are kind of widely accepted amongst traders. Generally it's 0.2% of your portfolio. But again, for the type of trades I'm doing, I know the delta will generally be high, and every time the market pulls back, the deltas will go higher. But let me just talk briefly about this one here. This is the new column that I put in, and this one is going to change only when I add new trades and sell more premium, or close some trades and remove some premium. And this is showing here, it's taken from this other page where it's just basically takes all of the open trades and takes into account all of the premium sold on the naked puts, because this is the guide that guides all of the other decision, the premium sold on the naked puts. So right now we're standing at 4,200 and change, and my rule now, until further back testing and further refining, and that's always subject to change because I'm always testing and retesting and using my old trades to figure stuff out. Until further notice, I'm using 10% as a maximum of my net lick. So at 47K, I would be looking at a maximum of 4,700 in premium sold. And this is on the idea that because the trades are structured to have a stop loss at 200% of this premium sold, that would mean, and obviously this is just assuming that there is no much slippage, then that there is no gap openings that would throw me out and not allow me to close in time, which all can happen. But our trades are pretty far out. The gap openings are not affecting me as much as it would some shorter term trades. So yes, of course, sometimes you can run over 200, but generally speaking, we're planning for 200. And also we're assuming that if all of the open trades, if the whole book gets wiped out, then we would lose double this, which would mean 20%. So it would be a 20% drawdown, assuming a worst case scenario without black swans. And obviously those are completely different animal. We would lose more, and so would most other people. And for something like that, you would have to think about black swan hedges and stuff, which is a separate subject. But for everyday drawdowns, everyday risk taking, I would assume double the premium sold would be my guide. So we are in line with that, and we are 42.35 out of 47 max, and we have 20 trades opened, and we could technically have another one trade open according to the relationship between VIX and our max buying power. So given that that's the case, we're actually going to go and take a look and see if we can open a trade. Let me see, MES. And I'm now generally looking, and this is again subject to back testing and the real life data adjustments, but I'm looking at 9 delta as I always have, but maybe around $22 in premium, and somewhere between 60 and 90 days. Usually it's going to be somewhere around 80 to 90, but let's actually first see 70, because with higher VIX it could happen in the lower, it could be right here, but we already have a trades here sold, and we don't want to overlap. 9 delta here would give us 21.75, which is fine, but we have a lot of them here already. So why don't we just go and take a look here? And just a second, why don't we just go to 9 delta here and see, we're getting $26. We can take a little bit less risk and just go for 23.5, which is fine. and quantity 2. Let's see if we can just get a little bit more money. Keep in mind that I do want to limit this premium received, because it's directly related to the risk I'm taking. Because if I'm taking 200%, the more I take on the naked puts, the more I'm willing to accept in loss. But at the same time, my put debit spread stays at 300 and will only protect me same as it would if I sold $22, or and because the put debit spread stays 300. So I don't want to go too far over 22. According to my numbers, that's roughly where I should be. Let me just find this. Oh no, I'm sorry, this trade is here. So let's just replace, go down. Looks like we're gonna have to go down a little bit more. Okay. Let's go to the mid price and okay, so 23, we closed for 23. We could pay up to around $11 for the PDS, but let's just go to 70, and then let's go to find something here. Let's go here, 36.75, and we just sold 35.50. Okay, so we are above that significantly. So 33.75, 33. So we don't have that one. We can go slightly down. Let me see if we go up. Okay, we could go either or. This one gives us a little bit less, but I think we're gonna go ahead and do this one. Let's just see what because we're gonna have to pump the price up a little bit, and because there is not as much liquidity on this. So okay. All right, so that's fine. We are now what we would call a full book. We have 21 trades on, and 36.7 is our buying power. So I'm gonna go ahead and fill our sheet later on, but I think that's all I wanted to share with you for today. And if you find this useful, please like the video and consider subscribing. And I will see you probably tomorrow for my weekly update and review. Thank you. Have a great weekend.